I have a buddy who retired to Florida a few years back, and every time we talk, there's something new. Insurance went up again. HOA raised the fee. Now he's looking at flood coverage on top of homeowners, and the number he quoted me last time, I had to ask him to repeat it. So I started wondering, is Florida actually the deal everyone says it is? Because you hear it constantly, move to a no income tax state when you retire. Get out of wherever you are, stop paying state income tax, let your money stretch further. And yes, there's real logic there. I'm not saying there isn't, but I went digging, and I want to be upfront about something before we get into the list. This ranking is not based on which state has the lowest income tax rate. It's not based on which state looks best in a headline. It's based on one specific question. Which states work best for someone actually living on a fixed retirement income, month after month, year after year? And that question changes everything. Because on a fixed income, there's a difference between a cost you can control and a cost that just arrives whether you're ready or not. Property taxes arrive. Insurance bills arrive. A healthcare gap shows up whether you planned for it or not. But a sales tax? You have real influence over that. A retiree who cooks at home, drives the same truck another 5 years, spends thoughtfully. That sales tax number moves. You cannot negotiate your hurricane insurance premium down. You cannot choose not to pay your property tax. You can absolutely choose how much you spend on taxable goods in a given month. That distinction, controllable versus uncontrollable costs, is what separates this ranking from every other list you've seen on this topic. And to be clear, this entire ranking is built around one thing: minimizing costs you can't control. If a state looks cheap on paper but hits you with rising insurance, property taxes, or healthcare gaps you can't manage, it drops hard. And very importantly too, this video is for educational purposes only and is not tax or financial advice. So please consult a qualified tax professional before making any decisions about your specific situation. That said, let's get into it. 5 worst first, then 5 best. Number 5 on the worst list is Connecticut. Now, Connecticut doesn't have California's reputation. The rate isn't 13%, and it's actually been improving the last couple of years. Why do you? A lot of people who put it in the bad list a while back haven't gone back to check. So here's the actual 2026 picture. Below $75,000 in adjusted gross income as a single filer, or $100,000 married. Connecticut exempts your Social Security, pension, IRA, and 401k. All of it. Zero state tax on retirement income. And honestly, for a lot of retirees at those income levels, Connecticut is fine. But here's the trap, and it's a quiet one. Cross those thresholds and the exemption phases out fast. By $95,000 single, most of it is gone. By $140,000 married, it's largely gone. Now think about what a typical retiree's income looks like. Say you've got a $72,000 pension. That alone puts a married couple at $72,000. Add $30,000 in Social Security and you're sitting at $102,000. You $2,000 over the line. And those $2,000 extra dollars don't just get taxed on their own. They trigger a phase out that starts pulling your entire pension back into taxable territory, at rates running from 3% up to nearly 7%, depending on your bracket. So the trap isn't the rate, it's the threshold. You manage your money carefully for 20 years, land $2,000 over that line by accident, and suddenly you owe several thousand in taxes you never saw coming. Every year from that point forward. Layer on Connecticut's property taxes, average effective rate around 1.7%, among the highest in the Northeast, and a retiree in a $400,000 home is looking at close to $6,800 a year in property taxes before income even comes up. Connecticut earns this spot because it looks reasonable right up until it isn't. And the line where it stops being reasonable arrives without much warning. Number 4 on the worst list is New Jersey. The complexity here is the problem more than any single rate. Social Security is fully exempt. That's a genuine benefit. Pension income has an exclusion, up to $100,000 for a married couple if total income stays under $100,000 and you're 62 or older. Sounds workable. Here's where it breaks. IRA withdrawals and 401k distributions in New Jersey are taxable. The state treats them differently than the federal government does, and there's some basis stuff involved. But the short version is pull money from a traditional IRA or 401k in New Jersey, and you're paying state tax on most of it at a top rate of 10.75%. So take a couple. $60,000 pension, $40,000 in IRA distributions, $20,000 in investment income. That's $120,000 total. Now they're over the pension exclusion threshold. The exclusion phases out. The IRA income is fully on the table. So is the investment income. That retiree is probably looking at somewhere between $3,000 and $4,500 in New Jersey state income tax. Maybe more. And then there's property tax. New Jersey has the highest average effective property tax rate in the entire country, over 2%. A $400,000 home in Bergen, Morris, or Essex County runs $9,000 to $11,000 a year. Some spots higher, and here's the thing about that $10,000 property tax bill. It arrives every year. It doesn't care how carefully you budgeted. It doesn't care that it's a hard month. It is an uncontrollable, unavoidable cost that will follow you through every year of retirement in that state. People stay in New Jersey for family. That's a real reason, and I'm not dismissing it. But staying because you assume the tax situation is under control, that's a different thing. The bill doesn't stay quiet just because you didn't look at it. Number 3 on the worst list is Vermont. Vermont catches people off guard because it doesn't feel dangerous. Mountains, foliage, quiet towns. People retire there for the lifestyle and the bills arrive later. Vermont starts taxing your Social Security the moment income crosses $50,000 as a single filer. That is the lowest Social Security taxation threshold in the entire country. Every other state that taxes Social Security at all starts the clock at a higher number than that. Your pension rates up to 8.75%. Your 401k, same. Your IRA, same. So a retiree pulling $50,000 from a pension and collecting $25,000 in Social Security is probably looking at somewhere between $3,000 and $4,000 a year in Vermont state income tax. In a state where property taxes are also among the highest in the Northeast. And then, this one gets me every time I look at it, Vermont has a 16% flat estate tax. 16%. So Vermont taxes your income every year you're alive and then takes another 16% cut when you're gone. Both costs are uncontrollable. Neither one responds to how carefully you lived or how thoughtfully you planned your spending. The scenery is real, but the tax math on a fixed retirement income is genuinely punishing, and most people who retire there did it for the mountains without ever sitting down and running what it actually costs. Number 2 on the worst list is Minnesota. And now, Minnesota doesn't carry California's reputation, and that might be exactly why people end up there without fully understanding what they've walked into. Minnesota taxes your pension at up to 9.85%. IRA withdrawal must spike 9.85%. 401k distributions, 9.85%. And if income is above roughly $84,000, Minnesota taxes your Social Security too. So a retiree with a $65,000 pension and $25,000 in Social Security, that combination puts them above the Social Security threshold, is paying somewhere around $4,500 a year in Minnesota state income tax. That's $375 every month, straight out of the retirement check, every single month for as long as retirement lasts. And you can't spend less to reduce it. You can't decide to drive the truck another year and bring that bill down. It comes out regardless, because it's a tax on the income that funds your life, not a tax on the choices you make. Now, yes, the people moved to Minnesota for the Mayo Clinic, one of the best medical institutions in the world, and for family. Both are real reasons. But $375 a month compounds. Over a 20-year retirement, that's $90,000 that went to Minnesota instead of staying with you. In most cases, nobody ever put that number in front of these guys before they made the decision. Number 1 on the worst list is California. Yes, California sits at number 1 for a reason that's almost simple. It doesn't give retirees anything. Most states, even ones that do tax retirement income, give you something. A Social Security exemption, an age-based credit, a pension deduction, some kind of carve-out that acknowledges you've stopped earning wages and you're living off what you saved. California exempts Social Security. That is the one carve-out. Your pension? Ordinary income, taxed in full. No deduction for the 30 years it took to earn it. Your 401k withdrawals, full progressive rate. Your IRA? Same. Your annuity income? Same. No phase out to work around. No threshold to stay under. No distinction between public and private pensions. If it's retirement income that isn't Social Security, California taxes it at up to 13.3%. So a retiree with $60,000 in pension income and $30,000 from an IRA is handing California roughly $5,400 a year. Every year. On money already saved and already taxed federally when it was first earned. Over 20 years of retirement, that's $108,000 in state income tax alone. And then the rest of the picture. Median home prices near $900,000 across much of the state. Wildfire insurance that has doubled in 5 years. In some counties, you're looking at $10,000 to $15,000 a year just for homeowners coverage. And in coastal and fire-adjacent areas, it's becoming hard to get a policy at any price. So you're paying $5,400 in state income tax and potentially $8,000 to $12,000 in insurance on a retirement income already being compressed by inflation and rising healthcare costs. None of those costs bend when you spend less. Every single one of them is uncontrollable. That's the full California picture. And it's why it sits at number 1 by a wide margin. All right, 5 worst done. And yes, the obvious move now looks like a no-income tax state. Florida, Tennessee, Nevada, problem solved. But here's what my digging actually showed. States with no income tax still need revenue, and they collect it somewhere else. Property taxes, sales taxes, insurance costs baked into the risk profile of living in that state. HOA fees in retirement communities that creep up a little every year. And in some cases, those other costs are bigger than what the retiree was paying in state income tax to begin with. That is not an edge case. It is common. So the best states list is built around one central question. Which states give you the most financial stability on a fixed income, month after month, year after year? Which ones put the most uncontrollable costs in the win column and leave the controllable ones in your hands? Here's what came out on top. Number 5 on the best list is Iowa. Nobody talks about Iowa in retirement conversations. That's exactly why it belongs here. Iowa recently rebuilt its entire tax code, and starting at age 55, all retirement income is exempt from Iowa state tax. Social Security, exempt. Pension, exempt. 401k, exempt. IRA distributions, exempt. All of it, zero. No threshold to trip over, no phase out, no income limit, just zero. And in 2025, Iowa eliminated its inheritance tax entirely. Gone. So the two biggest retirement tax traps, income tax and inheritance exposure, are both off the table. Now, Iowa has real weaknesses, and I'm going to be straight about them. Cold winters, limited lifestyle options outside Des Moines, healthcare access gets thin once you leave the major metros, and property taxes around 1% aren't as low as the top states on this list, but on pure retirement income protection, which is what most retirees are actually trying to solve. Iowa is doing something that almost nobody in the retirement space is talking about. The tax math is a genuine win. The trade-off is lifestyle and healthcare access, and for some people that trade-off is fine, and for others it isn't. Only you can answer that. Number 4 on the best list is Pennsylvania. Now, before you close the video, Psycast, yes, Pennsylvania has an income tax. And yes, that is exactly where most people stop reading. But what's actually inside that tax code for retirees is not what people think. Pennsylvania exempts 100% of your Social Security from state income tax. 100% of your pension, public or private, both. 100% of your 401k withdrawals. 100% of your IRA distributions. No income cap, no phase out, no threshold to stay under to keep it. The 3.07% flat rate only applies to earned income, wages, business income, and to investment income and capital gains. That's it. If you're retired and living on Social Security, a pension, a 401k, and an IRA, your Pennsylvania state income tax bill on all of that is $0. Now here's the aha moment. That same retiree in California paying $5,400 a year, in Pennsylvania, the pension is exempt, the IRA is exempt. If they also have $30,000 in investment income, they pay 3.07% on that. That's $921. So $921 against $5,400 every single year. And on the Roth conversion math, converting in a down market means you pay tax on a lower balance, and all future growth comes out tax-free. In California, a $50,000 Roth conversion costs you an extra $650 in state tax on top of the federal bill. In Pennsylvania, it costs you $0. IRA distributions are exempt. So why is Pennsylvania only number 4? 2 uncontrollable costs. Property taxes. In the parts of Pennsylvania where most retirees actually want to live, around Philadelphia, Bucks, Montgomery, Delaware counties, you're looking at $6,000 to $9,000 a year in property taxes on a typical retiree home. Some towns push higher, driven almost entirely by school district levies. That bill arrives every year and it doesn't respond to how carefully you spend. And the inheritance tax. Pennsylvania charges 4.5% on assets you leave your children, 12% on assets left to siblings. On $1 million estate passed to your kids, that's $45,000. That cost is completely outside your control. So Pennsylvania is an outstanding option for a specific profile. A retiree from the Northeast, not planning to move far, who wants world-class healthcare within driving distance, and whose income is mostly pension, Social Security, and IRA. For that person, Pennsylvania can be excellent, but those two uncontrollable costs, property taxes and the inheritance hit, keep it from climbing higher on a ranking built around retiree financial stability. Number 3 on the best list is Nevada. No state income tax, no estate tax, no inheritance tax. Property taxes ranking third lowest in the entire country at 0.47%. A retiree with a $400,000 home in the Las Vegas area pays roughly $1,880 a year in property taxes. That is the complete annual bill. So, income not taxed, estate not taxed, inheritance not taxed, property barely taxed. On pure total tax math, Nevada wins. The numbers are cleaner than any other state on this list, and no sales tax problem either. Nevada doesn't tax groceries. There's no 9.6% combined rate hitting your everyday spending. So why isn't Nevada number 1? Healthcare access. And I want to be specific about why this matters on a ranking built around retirees. Nevada ranks 35th in the country, about 188 doctors per 100,000 residents. Florida runs significantly higher. Tennessee has Vanderbilt, Pennsylvania has Penn Medicine and Jefferson Health. Nevada doesn't have that depth. And here's the thing. At 65 and healthy, that gap is invisible. You don't feel it. Nevada feels like the perfect answer. At 75, with a cardiac issue or a joint that needs replacing, or a specialist you suddenly need 3 appointments with in a single month. That gap becomes real. And it is completely outside your control. You cannot choose to need less health care. You cannot budget around a medical situation that hasn't arrived yet. So Nevada sits at number 3 because the tax structure is the best in the country. Cleanest numbers, lowest total bill, but it asks you to accept an uncontrollable healthcare risk that grows heavier with every year of retirement. For a healthy 63-year-old who's thought carefully about this, Nevada is a legitimate choice. For a ranking built around what works best across a full retirement, that healthcare gap costs it 2 spots. Number 2 on the best list is Florida. Florida at number 2. And yes, that's lower than most lists put it. Here's the honest reasoning. The case for Florida is real and I'm not going to understate it. No state income tax. Written right into the state constitution. No estate tax, no inheritance tax. The homestead exemption caps your annual property tax assessment. Increase at 3%, protecting long-term residents from runaway reassessments. The retiree infrastructure is unmatched anywhere in the country. Senior communities, geriatric specialists, retirement-oriented services that are deep, mature, and well-established. Airports everywhere. Healthcare access that is genuinely strong, especially in major metros. On infrastructure for retirees, Florida is number 1. Nothing else is close. But here's the number my buddy in Florida never mentioned when he first told people he was moving. Homeowners insurance in Florida now averages over $7,000 a year, highest in the nation. In coastal counties, Sarasota, Naples, Fort Lauderdale, you're looking at $10,000 or more before flood insurance even gets added. And that number has been climbing every single year. Now, here's why that matters on this specific ranking. That insurance bill is uncontrollable. It arrives whether you spent carefully or not. It doesn't respond to your choices. And it is growing faster than inflation, faster than Social Security COLA adjustments, faster than most fixed retirement incomes can absorb. A retiree who saves $3,000 a year by leaving a state income tax state and then spends $5,600 more on insurance than they would have elsewhere. That's not a win. That's a loss. And most people don't see it until they've already unpacked. Florida still earns number two because the infrastructure advantage is real. Inland Florida brings those insurance numbers down meaningfully, and the no income tax structure is rock solid. But it cannot be number one on a ranking that takes uncontrollable costs seriously. The insurance exposure is too large and too unpredictable. Number one on the best list is Tennessee. And here's where the honest ranking lands. No state income tax, no estate tax, no inheritance tax. Property taxes averaging 0.56% statewide. Vanderbilt Medical Center right there in Nashville, one of the top academic medical centers in the Southeast. Cost of living about 7% below the national average. Now you might be thinking, yeah, what about the sales tax? Tennessee has the highest combined sales tax rate in the country, roughly 9.6% when state and local are factored in. Groceries taxed at 4%. A retiree spending $50,000 a year on taxable goods is paying close to $4,800 in sales tax. That's real. I'm not going to minimize it. But here's the distinction that puts Tennessee at number one. That $4,800 is a cost you have real control over. You decide what you buy and how much. You cook at home more often. You drive the same vehicle another couple of years. You buy thoughtfully. That sales tax exposure actually moves when you make different choices. Compare that to Florida's $7,000 insurance bill that arrives whether you went out to dinner twice this month or stayed home every night. Compare it to New Jersey's $10,000 property tax bill that doesn't care whether it was a tight month. Compare it to Minnesota's $375 a month that comes straight out of your retirement check before you ever see it. Those costs are uncontrollable. Tennessee's main weakness isn't. And the rest of Tennessee's picture is genuinely strong. No income, estate, or inheritance tax. Property taxes among the lowest in the country. Vanderbilt for healthcare. Nashville and surrounding metros with real amenities, real restaurants, real infrastructure. Not just retirement communities in the middle of nowhere. Cost of living 7% below national average. Put all of that together. Zero uncontrollable tax costs. Low total fixed expenses, solid healthcare access, and a controllable sales tax as the only real weakness. And Tennessee wins the ranking. Not because it's perfect, because it gives retirees on a fixed income the most agency over their own financial situation, month after month, year after year. Oh, and agency on a fixed income is worth more than most people realize until they no longer have it. One more thing for 2026 that most retirees haven't factored in yet. The One Big Beautiful Bill, signed into law July 4th, 2025, created a new federal senior bonus deduction. If you're 65 or older with modified adjusted gross income under $75,000 as a single filer, or $150,000 as a married couple, you get an additional $6,000 deduction on top of your standard deduction. $12,000 for a married couple where both spouses qualify. The IRS confirmed this in February 2026. In effect for tax years 2025 through 2028. So, your federal taxable income drops by $6,000 before the state calculation even begins. And that changes the Roth conversion math in a way worth paying attention to. If you're between 62 and 73 and sitting on a traditional IDRA, yeah, converting in a down market, paying tax on a lower balance right now, means all future growth comes out tax-free. The state you live in determines what that conversion costs on top of the federal bill. In California, a $50,000 Roth conversion adds $6,650 in state tax. In Tennessee, it adds 0. In Nevada, 0. In Pennsylvania, 0. IRA distributions are exempt. And the same bill raised the SALT deduction cap from $10,000 to $40,000 for 2025. $40,400 in 2026. If you switched to the standard deduction back in 2017 and haven't revisited it since, run those numbers again now. For retirees in Connecticut, New Jersey, or Pennsylvania paying $7,000 to $9,000 a year in property taxes, the math may have shifted back toward itemizing by a significant margin. These are the details that don't make headlines, but they're the ones that actually move your bill. So let me come back to where this started. My buddy in Florida, the insurance call, the HOA fee that went up again, the flood coverage conversation he didn't see coming when he was packing boxes. None of that means he made a wrong decision. Florida is a real state with real advantages and a lifestyle a lot of people genuinely love. He might be exactly where he should be, but what he didn't do, what most people don't do, is run the full picture through the right lens before the move was made. And the right lens isn't just income tax, it's all of it. And specifically, it's the question of which costs you can control and which ones just arrive on their own. Because here's what the honest research shows. Every state on the best list has a real weakness. Tennessee's sales tax is real and controllable. Florida's insurance exposure is real and growing. Nevada's healthcare gap is real and uncontrollable. Pennsylvania's property taxes and inheritance hit are real and unavoidable. Iowa's lifestyle and healthcare limitations are real and structural. The best state for your retirement is the one where your specific situation, your pension amount, your Social Security, your IRA balance, your investment income, your home value, your healthcare needs, your family situation, comes out ahead on the full picture. Not the one with the best headline. Not the one your neighbor moved to. Run all the numbers, not just the one that made you feel like you'd solved it. I'm Edward Gray, a fellow retiree like you. If this helped you see something you hadn't seen before, hit the like button. Takes 1 second and it gets this in front of more retirees who need it. And drop a comment below. What state are you retired in, and what's your actual tax situation looking like? The most common situations in the comments become future videos. I'll see you in the next one.